Like I said, we like to talk about the financial topics that matter to your money and share with you the moves we're making for our clients as markets evolve. And like I said, it was a barn burner of a week this week, folks. It's April 18th, Good Friday. Happy Good Friday. Merry Easter on Sunday. And what do I mean by a barn burner this week? Well, there was some serious moves in all kinds of markets. Let's start with the stock market as it rolls over and ends the week near its lows as the bounce from the Trump tariff pivot fades and now looks like the proverbial dead cat bounce. I've got some interesting charts to show you so you will know when it's time to buy. Today's conversation is about when can people start to put some money to work. Then the other thing in markets, interest rates. The 10-year Treasury is sitting in a really, really precarious place. I'm going to show you what I'm watching for next week because it could be a really crucial, pivotal week. All this is playing out as Trump tries to replay his role in the Apprentice by saying, "Mr. Always Late, Jerome Powell, you're fired. You're the worst." So we're going to talk a little bit about, can Trump fire the Fed? Can he fire Jerome Powell? Does he have that power? If he did, what would happen in markets? And all this is going on, and the U.S. dollar plummets this week. For months, the dollar has been strong, strong, strong. And this week, it plummets against the euro and significantly against the yen, which is the most important. That helps push gold to new all-time highs. Silver and oil get a little pep in their step because of this. And now the big question is there a continuation of this unwind? They're going to call it on CNBC the basis point trade, but really what they're talking about when they say that, everyone, is they're talking about the yen carry trade, something that's gone on for 30 years and has funded liquidity to markets. And it's been unwinding for about a year now, and it kind of goes in phases. So those are the things. And why I say they're barn burners is because when you get moves like this in currencies, and then you have the 10-year Treasury right at this inflection point, and then you have stocks that everybody kind of got excited because they bounced 10% in one day, and now they're rolling over and look like they want to go test the lows that they made a week or so ago. And you have the potential for next week and the week after to be really, really exciting, maybe. I want to give all the Quiver financial clients a little early Easter present because as this news cycle gets even more topsy-turvy, I want to kind of give you an update on where we are. We started this whole process. So on April 1st, we were feeling pretty strong. All of the Quiver models were up anywhere from 8 to 10%. Our long metals model was up over 20% for the year. So we started this decline on pretty good footing. But on Liberation Day, we all got liberated from some of our money. And we went from being up almost double digits or at double digits to being up only 2-3% at this point. What saved us was gold, silver. What hurt us, or what had us give back our gains from the beginning of the year, was really the holdings that we had in oil, things like Exxon, Chevron. I don't feel so bad holding Exxon and Chevron and getting paid a 4% dividend while I ride out some of this torture. So even though I don't like the fact that we had to give up some of our gains, I do like the fact that we are in holdings. What we have left in the portfolio are very high dividend paying holdings. And we sit in a very good place to make purchases when this market bottoms out. So I'm going to get right into that today. And today's going to be really, less BS, more charts. I already kind of went through the headlines here. Let's get into the charts because I woke up this morning and I just, could not get this particular song, in my head. It was just, "We're not going to take it. No, we're not going to take it. We're not going to take it anymore." So usually days when I wake up with that, it's like the no BS days. So today's less BS and more charts. Let's dive right into the equity market because that's what everybody's really concerned about. We've been showing this chart since the beginning of the year. We were using it as a warning sign to let people know if you zoom out and you look at the S&P 500 since the Great Recession, you can see that it's pretty long in the tooth, that things were starting to get a little parabolic. The numbers that you see on this chart, the 1, 2, 3, 4, 5, those are wave patterns. Basically, to simplify this for you, when you start to get to the end of the fifth wave, you're coming to the end of that particular bull market. As the market has started to sell off, so here's an updated chart as of the beginning of April. You can see that from that 6,000 level, which is where the market made its all-time high, we've had a pretty rapid decline. In fact, it's been one of the fastest declines in history as the market has cratered. S&P 500 down over 10%, NASDAQ around 20%. The Mag 7 stocks are down over 25%. So it's been pretty brutal. There's been a few areas of the market that have actually held up quite well, things like utilities, things like consumer goods. If you go back and look at our stagflation playbook, those are the sectors that have performed fairly well in a bear market or in a massive correction. Even the stagflation playbook will struggle, and we've been warning. And now the big decision is this decline that we've seen in April, is it a buying opportunity? And when should you take advantage of that? Or is it the beginning of something bigger? Are we going into a bear market where for the next year and a half, 2 years, we should be considering selling every rip and not buying every dip? A little early to tell right now. I will say the market is behaving very bearish. So the behavior of a bear market is there. It smells and looks that way. However, I'm going to show you some charts here that really kind of will determine the longer term trend here. This is the S&P 500 basically from 2009 until now. The green line that I put there is a long-term support. And think of that as the reversion to the mean line. One thing that's really important in nature and in financial markets is the concept of reversion to the mean. And what I mean by that is that, as you can see here, as the S&P 500 really got parabolic over the last year, we got very far away from what you would call the average, whether it's a 200-day moving average or it's just a support line like I drew here as the green line. You can keep this in your mind as, hey, this is the balance line. This is the balance of nature, or the mean. And markets, when they get away from the mean, they will have a tendency to go back. It's the reversion to the mean. You can bet on it a million different times. I've seen it in my career. And so this is a perfect example of how the market got ahead of itself. It got too far away from the mean. And in this correction or bear market that we're going to experience, we're going to get closer to that mean. So you really don't want to be a buyer until we get a little bit closer to some support lines. So I'm going to trim this up, because what you have here in the dotted line is the intermediate to short-term bull line. We closed this week right on that line. For me, and the way that I'm managing the Quiver portfolios, in order for me to feel that the stock market could go make new all-time highs, if this was a buying opportunity and later in the year we're supposed to get above 6,000 on the S&P, then this decline needs to be held by this dotted line, essentially. We need to stay above that for me to feel that people can buy the dips. Once we break below that, and it's not just break it for a day, it's that we got to get below it and stay below it for a week. If that happens, then your target becomes closer to that green line, somewhere down around 4,000. And if you think about things, like if you think about the tariffs, it's pretty obvious that the tariffs are going to cause a slowdown in earnings. And when we were up here at 6,000 on the S&P, that conversation about earnings was everybody's at peak earnings, and we were starting to see in the last couple of quarters that earnings were decelerating. They weren't accelerating. So when analysts see that earnings are accelerating and the future has very few obstacles, they'll give stocks a multiple expansion. And so that's what drives the market away from the mean. When you have tariffs and all this confusion and uncertainty come into the mix, then the analysts go back, they sharpen their pencils, and they start doing calculations and say, hey, if such and such company's earnings decline X percentage, then their stock should be here. And when you look at what most of the analysts are doing as they're looking at the tariffs, is they're readjusting their models and they're readjusting them and kind of finding out that, hey, if the tariffs are somewhere between 10 and 30%, then probably the fair value of the S&P 500 based on earnings and what they can guess in the future here is probably somewhere around 4,200, which is amazingly similar to where the chart support is. So charts lead the news. So I would say that if we break below that green dotted line on the S&P 500 next week or in the next 2 weeks, and we stay below it, then the target starts to become down here. It's about, another 10% or so. So that's why I would say if you're eager to buy this market, be patient. We're not quite there yet. This is something that I shared on Twitter. If you're not following us on Twitter or LinkedIn, you really should, because I release things a little more timely there than these weekly videos. So right here is we have the green line now. In the past, what I showed you before, that green dotted line is now this solid green line that's essentially connecting all the lows of the S&P 500 back to 2022. This is the bull bear line in my mind, is that if the market can stay above this, so I'll go back just so you can, associate it with what I showed you before. So what we're looking at is this green dotted line is now right there, all right? And that is the line, the delineation in my mind of if you're above it, you're in a bull market, buy the dips. If you're below it, you're in a bear market, sell the rips. So that's what I'm going to be watching. I shared this with everybody 2 weeks ago where I said, really, the early indicator, if this is a buy the opportunity, was that early tell line, which was right around 56 to 5,800, which this week we tried to get to. We got to 5,400, and then the market rolled over. Okay, so because I was seeing that, I added some hedges to our accounts on Tuesday, and I'm glad we did, because shortly thereafter, Wednesday, Thursday, markets started to look like they're rolling over and could go back and test the early April lows. So for more conservative investors, you're going to really want to wait until you see something like this relative strength index start to pep up. Essentially, if you're a more conservative investor, if your time horizon is more sensitive, then what you're going to want to do is you're going to want to wait until you get confirmation that the relative strength index has bottomed out. This is not how it looks when it bottoms out. I'll show that to you when that time comes. It's not now. If you're a high risk investor, if you're young, you got a long time, and you can afford to try and grab a falling knife, then yeah, take a stab at it. But if you're a little more savvy or a little more prudent, follow us in the future weeks. I'm going to show you exactly when the timing will be, where you have some indicators that will support your purchase price decision making. All right. In the meantime, I would highly recommend that everybody go read our retirement red zone. So we have a couple of publications. The minutes from market minutes from the boardroom talks about the markets and the charts. Retirement red zone is written for people that are either in retirement or will be retiring very soon. I wrote a piece about discouragement because I really felt that by the time we get through this whole market cycle, there's going to be a lot of people feeling discouraged. So I went back and I pulled out all of my knowledge from the 2000, the 2008, the pandemic area, all the bear markets that I had to manage money through. And I just put some lessons about how to avoid the feelings of discouragement. And I highly recommend that everybody read it, share it with your friends and family, especially if you know somebody who might be feeling a little bit discouraged with the stress in the news and such. It's on the Quiver Financial website under Retirement Red Zone. It's in our blog. And in the meantime, if these videos are helping you, give us a little like, subscribe, pass it on to friends. All right, let's get back. I told you guys less BS, and I kind of just did a whole 5 minutes of BS. Sorry about that. All right, so let's get back into the charts and talk about the 10-year Treasury, because for the market to go higher, the 10-year Treasury, for the stock market to go higher, 10-year Treasury needs to behave. And right now, the 10-year Treasury is acting like an 8-year-old that had a little too much sugar and red dye, right? So we've been talking about this, that markets perform best when the 10-year Treasury can stay in a predictable range. And we've been in this range between, let's call it 3.5% and 5% for 2 years now. I would say this was like the end of March. I shared this chart saying, hey, here's our Goldilocks zone. And to trim this up in shorter time frame, I said to us that if we want to have confidence in our interest rate sensitive investments, traded REITs, utilities, things of that nature, then treasury bonds, then we would really need to see the 10-year Treasury stay below that 4.5% line. Now, I said this is charts from March 23rd. So since then, and then I said also, hey, the bottom is right around, call it just below 4.25. If we get below that, then the target becomes, 3.5. Well, since then, it's been a wild ride. I mean, the interest rate is like Mr. Toad's wild ride going on here. So, all right, where we ended that chart was right here. Okay. And so I'm going to give you back that line on the top end where I said, if we get up above 4.5, interest rate sensitive investments are going to get threatened. And then there's the bottom line at 4.25. We busted below that right after we published that chart. We got down to almost 3.75. And at that moment, I was thinking to myself, oh my God, this is amazing, man. This is going to be great for traded REITs, everything. And then Liberation Day. Damn you, Liberation Day. Liberation Day comes out, and the bond market has a complete revolt. And this move from below 4% all the way up to 4.5%, that is what got Trump to pivot. All right. Right there, that's when he got calls from all his people saying, whoa, dude, you better rethink this, because above 4.5%, and the wheels start to come off the friggin' bus. I didn't know that when we did the chart in March. The charts lead the news, right? But whoever's giving Trump advice is looking at the same charts I am, I guess. So we spiked there, and now this week we've settled down to 4.3, which is not great. In my mind, this is like Barkley came in the room. I showed this to him, and he goes, row. This is really, really concerning, because on a technical sense, see this circle I just put there? That's the low at 4.25 that we made in March. And that red line I just put on the screen, that was the low of the relative strength index. The next circle is the next lower low, when we almost got down to 3.75 before Liberation Day. And if you notice, the relative strength index made a higher low. Now, most people, you'd look at that and it's like an EKG. You're like, hey, doc, that makes no sense. What does that mean? What it means is that this type of chart pattern, when I've seen it in the past, it usually tells me that the path of least resistance is higher, not lower. So this is very, very concerning. And next week, what I'm going to be watching is that 4.3% level. Like we close at 4.33. If we get back to 4.4 and start to approach 4.5 early next week, I'm going to start talking alert, danger, Will Robertson, danger, and probably the market will as well. If we can get that back down below 4.25 and stay down there, then I'm not going to be concerned. But in response to this week, because of this threat, we didn't have a lot in EPR, Annaly, or AGNC. We had trimmed those before all this happened. However, earlier this week, because of this concern, I did trim up in the portfolios anything that was interest rate sensitive and hedged it to make sure that if we do go back towards 4.5 or higher, it's not detrimental to us. In fact, we'll try and turn it into an opportunity. So I'll report back to you over the next 2 weeks because I think this is really, really more important than anything else. So, like I said, 4.3 is what we're going to watch. What about always late Jay Powell? All right. Hey, you're fired, Jay Powell. You're the worst, right? That's what Trump was going to say here. That's what he's been saying about Jerome Powell. That's a big subject matter in the news. Bottom line is no, he cannot fire Jerome Powell. Not yet, not with the current tools that he has. If he did, it'd probably be some kind of political suicide. If that were to happen, that completely deteriorates confidence in the U.S. structure. So this is all noise. I don't think this is something that's going to happen. So if you hear about it in the news or it starts to get you worried that, oh my gosh, Trump is going to be a dictator and he's going to consolidate power and get rid of the Fed and, he'll have control of everything and the dollar's going to go to zero. Well, if he were able to do that, yes, dollar would go to zero. We'd have a lot of inflation. It'd be a really, really bad problem because no foreign investors would want to come into our market. So a lot of foreign investors are here because of the way we are structured. And once you start messing with the structure, you're going to have capital leave. So I think everybody understands in Trump circles the ramifications that you can't take confidence and put it into a spreadsheet and model it out. Once confidence goes, liquidity goes with it. So I think they understand that. So this whole thing around Jerome Powell is probably more noise than any substance. At the end of the day, Jerome's got a year. He's within a year and a half, he can be out. I mean, listen, all Jerome Powell has to do is treat Trump like you would like an alcoholic father. Just stay out of the house for the next year and a half and get to college, right? So that's probably what Trump just needs to do. Because all this is happening, I highly recommend that you guys go look at last week's video, the bear market playbook. It's 4 simple plays to game a bear market and win. So definitely get into that. So let's wrap everything up with gold and metals because gold made a new all-time high. That's the big barn burner, folks. Here's a chart. I always like to zoom out. And so here's a chart of gold over the last 5 years. You can see here that as I add a few things here, that gold is pretty far away from its mean. So if this line, the 200-day moving average, was the mean, you can see we've gotten very parabolic, okay? And anytime you start to get this vertical, and everybody's talking about it on the news, like it can't ever go down, then you're closer to a top than a bottom. I put this circle here, which was the last highs at the end of 2024 that we broke above earlier this year. And I put this red line at the relative strength index to kind of show you how this works on the upside. On rates, I showed you on the downside. So how this looks is we made a high, relative strength peak down, and then we busted in price above it. And right now, you have a situation where the price in gold is making new all-time highs, and the relative strength index is not making new all-time highs by any significant measure. Doesn't mean it can't. It probably will a little bit. But the fact that you have such an extended high from the last one, and the relative strength is peaking out, and most of the time when it gets around 80, that's the peak. So that is usually a pretty good sell sign. So that's why we've been selling our gold and gold miners into this rally. And we have one last piece of our allocation to sell. Now, I've kept silver because what I've seen happen in metals markets before is the Johnny come latelys that feel like they missed gold, they'll start to go pile into silver and silver miners as a catch-up play. So you could have a situation, and I don't know if we will, but you could have a situation where gold starts to go sideways or pulls back and silver becomes the leader. This is a chart of silver over the last 5 years, and you can see that it's way closer to its mean than gold. It hasn't had the run. And it's a lot easier to manage risk in a chart like this because you have all these little bottoms of support. So if you're making an entry into silver somewhere in here, you have a pretty clear level of stop losses to manage your risk. So I think you're going to see a rush of people coming into silver because when they start looking at the charts and realizing, oh, you know what, you're pretty close to support, you have a pretty good risk return measure here, that it could start to be the next thing in the metals market that gets a parabolic move. If it doesn't get a parabolic move, then it's going to fail here, get below 28, and be just a big disappointment. But I have an inkling, I have a feeling because of just the way the press and everything's working that silver should be on everybody's radar for a last time move. Again, I highly recommend that you read our Retirement Red Zone, the discouragement trap, because I'm telling you, if interest rates rise, stock market goes down, inflation comes back, people are going to feel pretty goddamn discouraged, and they're going to need some tips. And this is a great piece. You're going to love it, and you're going to think it's going to be probably one of our best writings, I hope. So give us a like and a subscribe. Until next week, if you get bored over the weekend and Easter, watch the Bear Market Playbook, where we give you 4 plays to game a bear market and win. It's on the Quiver Financial YouTube site, which is probably what you're on now. So like I said, give us a like. Ask your friends to subscribe. We appreciate all the support. Have a great Easter, and until next week, take care of yourself, and better yet, take better care of others.